Welcome to the video about pulling the trigger using Technician software. Day traders and long-term investors have many differences resulting from their time horizons. Technical analysis may tell the former to sell and the latter to buy, but the one thing they have in common is the act of trading. In order to execute their strategies, whether they are long or short-term, each has to put their analysis into action. The simple act of pulling the trigger to trade is the final setup. Once all charts have been marked up with trend lines, studies, and other technical tools, the technician needs to set the final criteria needed to trigger the trade. These factors include target price for a winner, stop price for a loser, and a price at which the trade should be executed. No matter what the opinion on a particular stock or index may be, there are several questions that must be answered. What is the ratio of profit potential to loss at my target and stop prices? Am I trading with or against the trend of next longer term? And should I trade at the current market price or wait for a better execution price level? The first two are easy to answer if the preceding analysis was complete. The third question is the difficult one in the subjective world of trading. The answer depends on the timing of the analysis. If the technical breakouts or reversal signals have already been made, then it may be too late to trade in that particular signal. It might be better to wait for the first correction. If these signals are about to happen based on the analysis, then it may be too early. However, if the signals have just happened, the best way to trade is usually at the market. We could assume that this last case will be the most relevant to the trader or investor who follows his or her market regularly. No fear. What does that mean? Once targets and stops are set and the trading signals are given, the technician can execute the trade with no fear. Losses are limited, and projected profits should make the risk of these losses worthwhile. In general terms, if the profit potential of the reward is at least 3 times the loss potential of the risk, the trade is worthwhile. With the proper risk-reward ratio, the value of 6 losers, let's say, is far outweighed by the value of 4 winners. So here's a chart of Amazon.com. It's a daily chart, and it's for most of 2014 into 2015. The stock shows a declining trend in late 2014 in the green line. However, as it set a lower low, its stochastics indicator set a higher low. So did its on-balance volume indicator, but we'll get to that later. So the divergence, or the difference in direction between the indicator and price, suggests that something was about to trade. And usually it's going to change in the direction of the indicator. When the green line broke to the upside, it was a great signal for a good trade. Note that this target, where it ended up, was commensurate with the declining trend line just broken. It was a swing trade and nothing more. Later, Amazon seemed to break through another short-term declining line. On-balance volume had been rising for months, so the pattern that formed, a bullish flag down in here, it seemed to be a good setup. However, on the final day, it formed an outside day to the upside with an arguable breakout from the flag. Admittedly, it would have been an aggressive move to buy the close that day, and of course we had no idea it would jump up the next day. But if your other analyses, or even the recent hold at support, the flat line, if that all made you bullish, then this was a good place to pull the trigger on a long trade. Note as well that the overall pattern bound by the 2 dark lines was a triangle pattern. At a minimum, we would have expected a move back to the upper line. The giant jump in price moved the stock through that pattern, so rather than view it as overbought and a place to cash in, it was actually an intermediate term breakout. This next chart is ExxonMobil in 2015. As we can see, it was in a bear market for a year when it accelerated to the downside on huge volume. That's in this area. This is called the selling climax, as the last bulls dumped their shares at any price. But that knocked supply to zero, leaving any spark of demand unopposed. Demand without supply forces prices to rise. And in this case, it happened in spite of a raging bear market in the oil market. The first significant rally day was the buy trigger, but that would have taken nerves of steel. However, the stock settled into a range with rising on-balance volume, and that's not shown in this chart. When it moved above the resulting triangle pattern and the 50-day moving average, it was again time to pull the trigger for a long trade. More aggressive here, less risk here. This brings us to the scenario of late analysis. A stock may have already broken out and is well on its way to whatever price objective is set. The technician now needs to determine if the remaining X points of profit are worth the now increased risk. The rule of thumb is that if risk-reward of the ratio is below 3 to 1, or maybe even 2 to 1 if you're more aggressive, it might be better to wait for a pullback and reassess the trade and then decide. In this chart of the Consumer Discretionary ETF, we can see a breakout and successful test of that breakout. But when it traded to the lower red line, the reward was a trip up to the resistance at the upper line. The risk was a few percent violation of the lower line, making the ratio on the order of 5 or 6 to 1. However, when the rally is this far along, the ratio drops to about 1 to 1, and that's not a good result for new long trades. Now, with this particular chart, even though it was a 1 to 1 ratio, just for the sake of honesty, this is what happened. Went up there, stopped the resistance briefly, and then broke through. But was it a good risk reward? Right in the middle of a trading range, I call it no man's land. So even though in this particular case it worked out, it won't always be that way. To complete this lesson, let's look at a losing trade and see that pulling the trigger to exit a trade is equally as important as it is to enter a trade. In this chart, the S&P 100 index, or OEX, seemingly broke out to the upside in July of 2015. However, within days it fell back into the old trading range by more than an acceptable amount. What is acceptable? Well, that depends on the trader's risk tolerance. At that point, we assume the original long trade was wrong and we get out. The big decline a month later was unusual, but a slow drift lower to return to the lower border of the range is usually the case. The lesson here is that action, whether to open or close a trade, must be taken as long as the risk and reward are properly assessed. The probability of success, perhaps making 60% losing trades, should not be feared, because the 40% that remain should far outweigh them.